Perfect. Now we shall go into understanding the FTSE 100. Okay, many who are listening to this more than likely have heard of the FTSE 100, but now we just want to break it down on a stockbroker level, as most and majority of the individuals you will be speaking to on the phone will have majority of their portfolio based in the UK main market, and the most liquid being the FTSE 100. So getting a better understanding of the market as a whole, reasons why investors focus and invest heavily within this market is going to be essential. And for yourself personally, building a broad understanding of the stocks that are involved is going to be essential, as well as the sectors overall. But when it comes to the FTSE 100, we're well aware a stock market index measures the performance of all the companies within. And so therefore, in this case, it's going to be the 100 largest companies listed on the LSE. And we go via market capitalization. It is the most widely used market here in the UK. But you've probably heard me mention the word market capitalization a couple of times now. In essence, it's a weighted index, meaning that the larger companies have a greater impact on the value of the overall index. Okay, it's calculated by multiplying the price of the stock by the number of outstanding shares that it has. So, for example, if a company has 20 million shares and they're selling at £50 a share, it would have a market capitalization of £1 billion. Okay, one thing that is important to know that the share prices will change due to various reasons, market conditions, economic conditions. So just because you may be a large company as of today doesn't mean next year, the year after, it will always be the same. But you will always get the major players always residing within the FTSE 100. One of the key aspects of the FTSE 100 is the diverse sectors. It is diversified across many different sectors, such as financials, energy, consumer goods, healthcare, and oil and gas sector. So the diversification does help provide a good balanced representation of the overall market. One thing to be fully aware is the market is not a reflection of the economy. Okay, it's not a true reflection. So you can't look at the FTSE 100 and say, due to the fact it's been doing well, that's a reflection that our economy is doing well. And I will explain as we go along. But when we talk about diverse sectors, it has a number of benefits, and that's what investors want to be focused on. Risk mitigation is one of the biggest parts. It helps you by having multiple different sectors. Diversification across those sectors will help mitigate any form of risk. So when you are speaking to investors and you are looking to build investment portfolios, it's important to understand the diversification benefits rather than pooling capital within one form of a sector or asset class as a whole. Um, Diverse sectors does provide a lot of stability in economic cycles. Okay, you are going to get defensive sectors such as utilities or healthcare, as they will provide a lot of stability during any form of downturn. But then you will get cyclical sectors within consumer discretionary goods, tech companies, but they may really thrive in an upward rallying market. Okay, so it's important to understand the portfolio you have and where does it sit in the current market condition. One of the main aspects of the FTSE 100 is the fact that it's a great form of income generation. Dividends are not massive, but they're very profound within the FTSE 100 rather than in the lower indices, as a lot of the largest market cap companies are happy to distribute profits to investors, whilst a lot of the small cap companies will rather tend to focus on reinvesting profits into new operations and focus more on the growth element of it. And one of the areas why clients do focus on the FTSE 100 is the growth element. Okay, there are companies which are up over 100% as of today, year on year, and a lot of that is based on the global rally we've seen with markets hitting all-time highs. So the growth element is still very much there. And as overall, we have touched on the global exposure element. A lot of these companies are dual listed. So, it does allow for investors abroad to have that international diversification. It's a great way to gain exposure into new markets and add further revenue streams. Brilliant. We're going to go straight into beta. Now, beta, in essence, is the sensitivity of a stock or an instrument compared to the overall market, especially when we're talking about finance. We want to know how sensitive or how volatile a stock is compared to the current index. You may have a beta of 1, which indicates that the stock will replicate the movement of the overall index. So if the FTSE is up 1%, you will have stocks which are pretty much up 1% or there and thereabouts. You could have high beta companies where their beta is greater than 1. That suggests that they are more volatile than the overall market. So if the market is to rally like we're experiencing as of now, and the market's up 1%, high beta companies greater than 1 will be up maybe 2, 3, 4, 5, 6%. It can absolutely vary. But on the flip side of that, if the market does fall 1%, a lot of these high beta companies will have a tendency and have a history of showing they'll be down 2, 3, 4, 5, 6%. So that's one way of looking at it. In a low beta company, these companies have a tendency of mimicking the overall returns of the market, so they tend to be less than 1 or close to 1. So if the market does rally as we've experienced, the low beta companies naturally won't rally as hard as the high beta companies will. But if the market is to fall, low beta companies have shown and are proven to do well in a very uncertain market. Now you may ask yourself, look, why is that essential to the role? Well, when you are speaking to investors, your aim is to understand what their investment objective is. By clearly asking, just out of interest, what is your investment objective? And they focus on saying they want a portfolio that will do well in a positive market. Then you say that's absolutely fine. Then you want to question, what stocks do you currently have in your portfolio? And if they mention stocks like United Utilities, National Grid, maybe even something like Glaxo, these are companies which are traditionally classed as low beta. They tend to mimic the market as mentioned, not necessarily outperform. Okay, so by asking this question of that nature, you are already isolating the fact that this individual may not be seeing the best return as per his objective. You may want to approach a situation like that and make them aware. So you may want to consider looking at sectors such as XYZ as they have a history of performing well in that sort of market. So you may want to isolate maybe banking, mining, and without giving advice, of course, you can tell them about the history. They have a proven track record of doing so. So that's what you may want to do. But if you do ask another client, ma'am, what is your investment objective? And she says she's uncertain about the current climate and believes that the markets are going to collapse. You would want to fire back and ask, what stocks do you have in your portfolio that will benefit from, a market pullback? And if she mentions she's got, Barclays, Anglos, or Fresnillo, all high beta companies, you may want to make her fully aware. Looks, if the market is to collapse, the stocks that you have traditionally tend to do well in a rallying market. But if the market is to have a pullback as you described, you may want to look at sectors such as XYZ, as they have a history and a tendency to do well in a negative market. So it's essential that you understand beta and the relationships between stocks and the overall performance of a market, as that will help you diversify and build portfolios based around certain objective or certain risk parameters. Okay. Now, when we talk about cyclical and defensive sectors, beta has a big influence on that. Cyclical sectors such as materials, industrials, and consumer discretionary goods tend to have high betas as they perform, you know, very closely to the overall economic cycle, whilst as defensive sectors such as utilities and healthcare typically have lower betas because their products and services are less sensitive to changes in the economic conditions. Market capitalization has a big impact. Large market cap companies often exhibit, um, lower beta values compared to smaller stocks. You will realize that as we tend to look at markets or indices with slightly lower liquidity and market cap. Large market cap companies always tend to be more stable and less volatile. But that being said, as mentioned in my examples I've got here, there are sectors which are still classed as high and low beta. So that's something you would want to consider. Market conditions, betas can vary depending on the current market conditions, okay, especially during expansions and bull markets. We've already mentioned uh, betas across, many sectors tend to improve as risk appetite does arise. So be fully aware, but the sectors that I've mentioned are the ones that you would want to be focusing on if you are trying to build somewhat of a balanced portfolio for investors moving forward. Now, liquidity is an essential element of um, many markets, not necessarily just within stocks, within currencies, commodities. Liquidity plays a big part, and indeed, the FTSE 100 is considered highly liquid. It's important to know that liquidity can vary across individual stocks within the index as a whole. So some stocks may be more liquid than others based on factors such as market cap, trading volume, as well as investor interest. So it's essential to not paint every stock within the same with the same brush as we've discussed with beta. You will get slightly higher beta stocks than others, and that in itself can dictate how you will build an overall portfolio. So let's look at some of the factors that contribute toward liquidation and the liquidity of an individual stock. Large market capitalization stocks typically have high liquidity as they are often more actively traded and they attract a broader investor base. Global exposure has a big impact on that, and as that will involve attracting a wider range of investors, which does include international participants. We're not just talking about retail investors here, we're talking about the big asset managers, hedge funds, investment banks. That helps increase liquidity as there are more buyers and sellers. The FTSE 100 benefits from the fact that it does have diverse sectors. So that does enhance the overall liquidity of the market, okay, and it allows investors to choose from a variety of sectors which contribute towards more liquidity in the market. Market makers, we have touched on earlier, they play a crucial role within the liquidity as they have an active involvement in order to advertise these stocks and provide bid and offer spreads. So it allows small investors, larger investors to get further exposure. Trading hours is something that's crucial in the liquidity of the FTSE 100, especially due to the fact that there is an overlap of a number of time zones. It does engage a lot of trading activities and increase the overall market activity, and that naturally will lead to higher trading volume. So, the key to liquidity moving forward is just, understand that obviously the FTSE 100 will have the more liquid stocks, but as you start going down certain indices, the 250s, the small cap and the AIM, the liquidity will diminish. But just understand what makes a liquid stock and what doesn't. One important factor you must consider when considering the FTSE 100 is the significance of the dollar. As I mentioned earlier, the FTSE 100 is not a true reflection of the economy. no market really is. There are a lot of close relations, and you can use it as a barometer, but especially with the FTSE 100, you can't use it as a better understanding of how well the UK economy is doing, because majority of the companies that are listed on the 100 are multinational corporations with a lot of global operations. That being said, in the region of 70% of the FTSE 100 stocks are companies which do a lot of their business with dollar, or a lot of their financial reporting is within the US dollar. So that's their more common currency for international trade, financial transactions, and any other form of reporting. So that's one thing to really bear in mind. So when we talk about having a strong dollar, this is when the dollar strengthens, the value of the foreign currency relative to the dollar typically decreases. This can lead to higher reported revenues and profits. So companies then overseas, their earnings can translate to performing very well. So if we talk about a strong dollar, that will have a positive impact on companies that are based here in the FTSE 100, and that naturally tends to drag up the FTSE 100. So if we have strong data, for example, out of the US, such as non-farm payrolls, and more jobs were created, that naturally tends to lead to a stronger dollar. So the dollar rallies against a lot of its peers that it may be tracked against. And that being said, the FTSE 100 tends to go up. If you tend to see a weak dollar, doesn't have to be data related. A weak dollar, you will naturally tend to see the FTSE 100 depreciate in value. So always be fully aware of that. A strong dollar tends to lead to a rallying market in the FTSE. A weak dollar tends to lead to the FTSE 100 going down. Now, commodity prices will be massively impacted, as the majority of the commodities are priced in a US dollar. So a stronger dollar can lead to lower commodity prices, which may benefit certain sectors within the FTSE 100 in particular. So lower input costs for commodities can improve profit margins for the companies, and that's why investors would be more than likely to purchase these stocks, as their results and their end of year earnings would be quite beneficial perhaps, and that would be one of the reasons to invest, and in turn stock prices will tend to rally. Investor behavior, a stronger US dollar will signal a lot of confidence in the US economy, as well as in its currency, and that will influence a lot of investor sentiment and appetite towards risks. So investors may perceive a strong dollar as a sign of economic strength as well as stability. This will lead to them, allocating further capital to global markets, and that will also include the FTSE 100. Increased demand, as you know, will always tend to contribute towards higher stock prices. So, that being said, just to reiterate, a strong dollar tends to mean that the FTSE tends to go up. Weak dollar tends to mean that the FTSE goes down. So whenever you are speaking to your clients and you are giving the market updates, make sure you keep a close eye on currency pairs, whether it's sterling, dollar, euro, dollar. See how well the dollar is performing against them, and that will naturally dictate which way this market will go. Keeping a close eye on the economic calendar is going to be essential. So it's all part of the mantra of keeping clients updated, well informed, and really just understand how the dollar has an impact on your market sentiment. Okay, looking at the type of investors that would invest in the FTSE 100, you will have your traditional retail investors, which is the likes of you and I. We can have a different objective. We could have more of a long-term focus. We could have a short-term focus, or we can be purely income-seeking, trying to target the top dividend-paying companies. So those are your traditional investors, and the ones that majority of the clients will be. You will also get institutional investors. These will be the hedge funds, the pension funds, asset managers. These are naturally the big players. These are the ones that will provide the most amount of liquidity into the market. So if you do see a lot of adverse swings, it's usually based on a lot of institutional banks really either buying or selling. Okay, retail investors don't have that much of an impact on the FTSE 100. You will also attract international investors, so anyone from abroad that wants to have exposure within the UK markets. Those are the sort of investors that will come over. So be fully aware when you are speaking to your client, if they are a retail investor, make fully aware what are their objective. Are they trying to seek a long-term objective? Are they benefiting from the dividend income that can be seen? Or are they looking to really take short-term movements? Are they looking to hedge their overall portfolios? Are they benefiting from any, are they looking to benefit from any form of swing on the downside that you could possibly see? So it's always important to understand not only your client, but what are their objectives, and by matching that with looking at liquidity of stocks, matching that with betas, that will give you a better understanding of how to put ideas and strategies in front of clients. Remember, you can't give advice. It's important to give strategies and potential solutions to clients. Okay, the pros and cons of investing in the FTSE 100. It's essential that you know the reasons why investors would want to focus on the UK main market and why they wouldn't. Okay, a lot of the cons are going to be very similar to no matter what market that we're going to look at, so always bear that in mind. But when we focus on the positives here, we do focus on diversification. We have touched on it a couple of times now. The FTSE 100 does have a range of sectors from finance, energy, healthcare, so it does allow you to spread your overall risk, which is important. Then you look at the liquidity element. A majority of the companies are incredibly large. They have a very significant market capitalization, so they are highly liquid. If you just look at the order book, the amount of buyers and sellers that are in there, it does help the fact that the liquidity is very much there, so you can buy and sell the stock you want at the price you want. Global exposure, a lot of these companies are multinational companies, so they do attract attention and investment from abroad. Dividends are a key factor of investing, as especially certain age groups, such as the older you get, you may want to be focusing on the income side of it, and the FTSE 100 have some great dividend payers within there. Transparency, look, the markets are very visible. You've got a lot of attention attached to it. So you've got the order book, for example. The order book will give you a great understanding of, the buyers and sellers, the quantities, the sort of support and resistance bands that may be attached to an individual company. They're very transparent, very easy to read, and on pretty much every financial website you will look at. When we mentioned there are blue chip companies, that's down to the fact that they are the largest market cap companies. A lot of them are going to be household names. The con side to investing is the currency risk. We have touched on the fact that majority of the companies are US, or they are companies based abroad, which do a lot of their financial reporting in dollar. So a strong dollar, as we know, will rally the market. A weak dollar will tend to send the markets lower. Investor appetite for risk may not just be there if we are seeing weakness in the dollar. So that's something to keep a very close eye on. Concentration risk. When we talk about concentration risk, we're talking more on the sector standpoint, because a lot of the concentration is focused around finance as well as mining. So if we do see a huge amount of negativity in the market, remember these tend to be very high beta sectors. That tends to mean that we could see somewhat of a drawdown or a pullback within the overall market, and if we do see that, the markets tend to fall fairly hard. So there is a slight concentration risk, but it's part and parcel with a lot of companies or indices out there. Market volatility. Now, just like any market, there is going to be a lot of volatility. Prices can fluctuate depending on economic conditions, geopolitical events, and other factors, leading to short-term pullbacks, which could turn into short-term losses. You will have some form of interest rate sensitivity within the 100. as a majority of the sectors such as finance, financials, banking, insurers, rising interest rates can affect profitability, or even lowering interest rates could. So be fully aware of any interest rate decisions, especially right now. If you're reading or listening to this in 2024, we naturally have seen interest rates rally over the last number of years fairly hard. But we have seen the financial firms do very well in that by having record profitability. It has led to the US increasing interest rates as well, which they have done for the last number of years, which has strengthened their overall currency, which makes it that bit more appealing. So risk is very much on in this current market climate. But yeah, those are the pros and cons of the FTSE 100.